Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves Review for week ending 18th of June. Of course, today is Monday, 21st June. My name is Carl Capilingua, and I'm the market analyst over at Think Markets Australia. It's a pleasure to be with you as we delve into all the big broker upgrades, downgrades, price target changes, and more. We'll do that after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, no hidden platform or subscription fees, and a world-class trading app. 5 fantastic reasons why your next ASX share trade should be with Think Markets. But if you're new to the Think Markets family, sign up, get trading before June 30, not long now, and your first 5 trades are on us. There are some T's and C's, so head to the website for further details. As suggested before, the agenda for today is to check out all those big broker moves from the week for last week, and then we'll look at a stock of interest as well. Let's kick off with the upgrades first, and don't forget each broker has a system of ratings for each of the stocks that they cover, typically based around what they think their clients should do with that company. Buy, hold, sell are the main ones. And we can see here Coles Group at Macquarie going from neutral to outperform, retaining their $17.30 price target, which leaves about 4.6% to the upside. Coles Group incidentally had a trading update during the week, or an investor day trading update, where they told the market that they would be increasing their capital expenditure on improving their supply chain and online presence. They also said that they would experience higher rates of depreciation as well, and that triggered a couple of downgrades by a couple of brokers, which we'll see on the next slide. But Macquarie, in this case, saying that recent share price depreciation makes Coles quite attractive at current levels, and switched it to their preferred sector pick. Looking at the next one there, Iluka Resources, also at Macquarie, going from neutral to outperform this time. They did increase their price target from $7.30 to $8.60. That is a very nice 17.8% increase in that target price. And based upon the current price to that target price, they still see about 10% worth of upside. Nothing really specific there. They did upgrade a couple of their other commodity price assumptions recently, and Iluka just a beneficiary of that one. Macquarie also on Seek going from neutral to outperform price target, a very nice 26.6% to the good there, and leaving 22% worth of upside. Macquarie noting that the recent removal by the company of recruited discounts would provide earnings tailwinds, also with unemployment in Australia expected to fall into the low 4s by 2023. This should have a positive impact on ad volumes and therefore on the Seek business. Looking at Sims Group, JP Morgan going from hold to buy there. Nice price target increase, also 22.7%, leaving 27.5% in it. Sims Group upgrading their earnings during the week, increasing their earnings guidance range for FY21 from 260 to 310 million up to 360 to 380 million, so the bottom end of that range up 38%, very nice. The company cited higher margins and commodity prices for the upgrade, but JP Morgan very positive towards the stock. Heading into the next page, we'll see the broker downgrades here. CGF going from buy to neutral at UBS. The price target falling from $7 to $5.80, that's a decline of 17%, but the broker still seeing about 9.4% upside left in it from here. UBS complaining that management has lowered their return on equity forecasts for the company, and as a result, UBS now expects this metric to trend lower in the future. Coles Group, a couple of downgrades we mentioned earlier here from Citi and Credit Suisse, both going from buy/outperform to neutral, and both reducing their price targets. Citigroup by about 4.4% and Credit Suisse by 5.7%. Both brokers seeing a little bit of upside left in it, but with less than 4%, you can see why they've gone to neutral. Also, I should say, both brokers citing the increase in capital expenditure and increase in depreciation as reasons for the downgrade. Macquarie on CSL, they have gone from outperform to neutral. They retained their 312 price target, which leaves a very slim 2.1% in it. They said that foot traffic at blood plasma collection centres in the US has slowed down, and with the company benefiting recently from a large share price appreciation, Macquarie no longer seeing the value in CSL that they did a while ago, hence the downgrade in the rating. JP Morgan on Downer Group going from hold to lighten, quite a large price target decrease there from 590 to 530, just over 10%. And even with that price target decrease, JP Morgan still thinking that Downer Group is overvalued at this point. I guess that also explains the rating. Now, JP Morgan said that Downer Group is going to be one of the major victims of a significant labour shortage, particularly in WA, obviously with unemployment low and falling, particularly in my home state of WA, and a resurgence in the mining sector. Downer Group is going to struggle to get the requisite skills and potentially have to pay more for them, and that's going to have a negative impact on their earnings going forward. Morgan Stanley on nickel / copper / lithium / cobalt explorer and producer there, going from equal weight to underweight. They did increase the price target though from 565 to 635. That's a 12.4% increase. But even with that increase in the price target, the broker's still thinking that the company is overvalued. They do like the company overall, though, saying that they are pleased with the strategic shift the company has made in recent times to become more of an electric battery storage mineral supplier going forward. But simply the share price is just too high based upon their valuation. They did say that strong cash flows will probably persist into the future and give the company scope to continue on its growth path through acquisitions, or potentially increase its dividend yield going forward. So some good and some bad there in that one from Morgan Stanley on IGO. Invocare at Citigroup, they went from neutral to sell on that one. A large drop in their price target, and the company's still overvalued by about 13%. Citigroup cited market share losses, higher capital expenditure, and even a lower death rate in the short to medium term locally due to changes in behaviour due to the pandemic. A few people going out and having horrible accidents, unfortunately for Invocare, fortunately for those people. Credit Suisse on Suncorp went from outperformed to neutral. They retained their 11.80 price target. A little bit of upside left in that one. That downgrade there mainly due to recent share price appreciation, but also noted $50 million of extra charges from the recent Victorian floods. Citigroup on Whitehaven Coal, they went from buy to neutral. They did increase the price target though by 10%, which still leaves about 18% of upside in it as far as Citigroup's concerned. They were quite positive on the company overall, saying that they would be a beneficiary of higher thermal coal prices. In fact, Citigroup upgraded their thermal coal price expectations from about $83 US a tonne to about $92, $93 a tonne. But they said the recent surge in the company's share price left it somewhat fully valued. The last one there, Macquarie on Woolworths Group, going from outperform to neutral. They did retain their target of 44.50, which means that it's pretty much fully valued as far as they're concerned. And they said that the recent share price appreciation, again, undermining the valuation of the company. And whilst the broker likes the medium-term growth outlook, they are switching to coals as their preferred pick in the sector on the basis of relative valuations. Hence the upgrade from Macquarie on coals on the previous slide. Okay, looking at price target increases now, so no change to the ratings on any of these. We'll just stick to the bigger ones, I think, and if you'd like to press pause at any stage during the rest of the presentation, please do and see if your stock's on screen. Let's go to Domino's Pizza Enterprises, ticker code DMP. Citigroup, a nice price target increase there of 15.2%, but only getting it to bang on, spot on their target. They retained their neutral rating. Citigroup said that they upped that target in response to the company's recent announcement that they would acquire Domino's Pizza in Taiwan and therefore increase their Asian footprint. Looking down the list, we've talked about Morgan Stanley and IGO, their 12.4% increase. We've also talked about Iluka Resources. ResMed, I would say that's a little bit of catch up there from JP Morgan. The share price has popped up over the last couple of weeks, and JP Morgan, as you can see, catching up there with only 1.6% upside left in it, retaining their accumulate. Looking down to Seek there and Sims Group, we've talked about both of those previously in the upgrades, downgrades, so we might keep moving. Into the last few here of price target increases and Tyro payments. That's a nice pop up there, 12.2% increase in the share price from Morgan Stanley. Morgan Stanley still seeing nearly 20% of upside in the company, retaining their overweight rating. The broker impressed with Tyro's performance and the way they handled the big outage they had in January, February this year. They said that the systems that they've put in place, the solutions to that outage that they've had to devise, have put them in a better position than their competitors in terms of dealing with future outages. So I guess there's a silver lining. They also said that the recent deal with Bendigo and Adelaide Bank to supply hardware and software to the bank's customers will be transformational in terms of the company's earnings. So some nice comments from Morgan Stanley on Tyro. Okay, not so lucky now. Price target decreases. We've talked about the Challenger and the Coles ones. We've talked about Downer Group. We've also talked about InvoCare. Monadelphous, a downgrade there at Macquarie by about 10%, but still plenty of upside seen in that one and retaining their outperform. Nuix at Morgan Stanley, they said that the company was in the middle of some big changes in terms of key personnel, and that would undermine investor confidence. In the meantime, even at that 640 revised lower target, Morgan Stanley seeing 143.3% of upside, retaining their overweight rating. Looking at Regis Resources, the gold miner, Morgan Stanley decreasing their price target because they think they did pay a little bit too much for their recent Tropicana acquisition, but did note fundamentally the company still looks quite attractive. Hence, their price target is still some 43.7% above the current share price. They retained their overweight rating. And on ServiceStream, Macquarie dropping their price target by a considerable amount there, 32.1%. Still about 10% upside left in it. Macquarie retaining a neutral rating, and the broker blaming ongoing delays with the NBN rollout, hindering ServiceStream's ability to provide their ongoing services around that project. Okay, just the one feature stock today was the most widely covered by the brokers this week, and it's Coles Group. We can see there we've got Citigroup first up, the broker blaming the increased capital expenditure for that downgrade, but noting that the investment in the company's supply chains and online sales channels is welcome, but probably won't do much to the bottom line apart from increased costs and therefore reduced earnings by 4% in FY22 and 8% in FY23. Credit Suisse also with the downgrade there. Let's just go ditto on that one. They said potentially also lower population growth might be a negative factor going forward. Macquarie Group, they had the upgrade from neutral to outperform. They said that the increased capital expenditure was the reason for reducing the price target. Now, this is an odd one because at the start of the week, they increased the price target from 1730 to 1820, and then after that announcement by Coles, they reduced it back from 1820 back to 1730. But they said that they remain positive on the broader outlook and retain their outperform rating due to the attractive valuation and Coles moving to their key pick in the staple sector over Woolworths. Morgan Stanley lowered their price target from $20.25 to $19, retained their overweight rating. They were pleased with the company's comments regarding normalisation in consumer spending patterns, indicating that the disruption they had through COVID is temporary and not structural or more likely to be longer lasting. They did lower their FY22 earnings estimates by 5% and by 4% for FY23 as a result of the increased depreciation and expense charges. The shares appear to be oversold, according to Morgan Stanley, so they retain that overweight rating. If we look at what the rest of the brokers are saying, or the average of broker recommendations, we are actually at a buy for Coles. We do have one strong buy, 5 buys, 7 holds, and nice to see no sells or strong sells. We have a mean target of $18.04, which leaves a fair bit of upside in it, but looking at some of these price target downgrades here, that will probably trickle a little bit lower as some of these ratings find their way into the system. We do have a high estimate of $20.30. Looking at the fundamental numbers, enterprise value to revenue at 0.8 is very, very good. The market average is somewhere between sort of 3.5 and 6. Price to earnings ratio is not fantastic, you would say, at close to 22. It is expected to fall into FY22 because there is a little bit of growth in the business, but with a PEG of 4.11, that growth isn't substantial enough to justify that high PE. Dividend yield is quite attractive, to be fair, at 3.8%. Price to free cash flow is good. Price to book value is okay, and return on equity, to be fair, is outstanding at 32, falling a little bit to 30% in FY22. So overall, quite a strong looking set of fundamentals for Coles Group. I'm happy to give that one a B+. I'm pretty happy with this over here. The chart, not as happy with. Look, we've actually switched into a long-term downtrend after we broke through the uptrend earlier on this year. We have done a reasonably good job at setting a base around that sort of 15.50 mark. I like the way we've sort of moved back into higher peaks and troughs. And to be fair, it actually wasn't looking too bad until really this announcement, and we've seen the price drop back below that long-term trend. The long-term trend swing back to down. We're below the short-term uptrend that was developing. Some reasonable candles in here, but I think a long story short is the best way to go and say that's a pass for me. So there are some constructive elements there in the technicals to suggest that we've probably seen the lows for the time being, but then there's not enough evidence to suggest that we're going to be rampaging higher anytime soon. So let's go, as I said, tick, and just a pass for me on that one. Well, that's it for today's presentation. You can catch all of our ongoing market news updates in the market news section of the website. You can follow me if you like, or the Think Markets handles on Twitter. Make sure you head over to the webinar section of the website and register for tomorrow's Ask the Experts. That's where you get to bring your portfolio to the table, tune in and ask me about any stock or index or commodity that you're interested in. Could be a crypto as well, and I'll give you a quick fundamental and technical. Register also for next week's Crash Course in Crypto. That will be very interesting. And then we'll be revisiting a fortnight after that the top 3 ASX turnaround stocks. So that's Appen, Kogan, Treasury Wine Estates and A2 Milk, and we'll add another turnaround stock of interest. The disclaimer before I leave you says that everything we've discussed today is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposits, so it's very important you read this disclaimer carefully, or if you have any questions at all, please give us a call. It's been a pleasure chatting with you today. All the best for your trading until we catch up again. Bye-bye for now.